stream rolling here so we can get going. You guys can always just go directly to YouTube and jump on this, but Zoom is easier so I can see your chat. But either one works. We're now rolling here on YouTube. I am just saying hello to everyone for those of you just tuning in. Hope everyone is doing well. And I was just saying, I think right now the market's right around break even. Qs are about 0.12%, SPYs about negative 0.5%. That has to do with financials mostly there. And I was just saying, I think if we finish around a break even day, it will have to be literally the craziest break even day maybe in the history of the stock market, certainly in the last few decades. For the market to move 8% intraday and then finish somewhere around break even, totally unheard of, totally insane. And, the reasons behind that are also insane, which we'll get into. Now, I'm going to start sharing my screen here, but you guys, I'm sure, know the first question I'm going to ask. The first question I'm going to ask is, who got a piece of the pair trades that we put on Friday and made some money? That's always what I want to know first. Who is making money? Because that is why I'm here, is to try to help you guys make money. And so I'd love to hear the feedback, first of all, from that. We're going to get another trade on today. But we took 4 different pair trades on Friday. Every single one of them should be profitable for you folks. Some bigger than others. If you close the SPY and the MAGS trade first thing this morning, that was a whopper that we got on that pair trade. Walmart and Target I still have open, but positive. XOM and COP, that one's only a couple percent positive, but still positive. And then we had IBIT and BITO, which were really nice as well. So shoot me out a yes if you guys were in on the Friday session. You either put those trades on or at least kept an eye on them, because they were all really nice, especially, again, with that big old pop on the QQQ opening down about negative 5%. I think that option was up like around 170% or so. And so those were some really nice ones. Yep, love it. Always great to get winners when the market is going crazy. And that's one of my favorite things to do with those kind of trades. Like I said, we'll jump into another one and I'll recap the specific ones here in a moment. Before we get into that, let's just kind of talk about the main overview here and roll into that. So obviously we've got the sectors for the week, which are just as crazy as everything else in the market. Dipped down, most of them down 4 to 5% at the market open. You can see here, this is just from the Friday close, by the way. This is just looking at the sectors from the Friday close here all the way to right about current. This is about a half hour ago. And you can see most of our sectors, including technology and discretionary, which are the most risk on and been getting hit the hardest, were down over 5%, several of them down 4 or 3%. And then literally in the 15-minute fake news on the potential for tariffs to be delayed, we saw many of these sectors move 10%. Technology moved 10% in about 15 minutes on the news that potentially those tariffs would be paused, which appears to be fake news. But it's just crazy because that represents like, $7 or $8 trillion moving, changing in the course of 15 or 20 minutes. It just shows you how unstable the reality of the stock market really is when you actually look at it. Yes, the market over time ends up being, net stable and bullish, but in the here and now of it, the market is incredibly unstable. Now, why is the market so unstable? Well, because we're not really looking at any true value proposition here. We're not even really looking at the reality of the news. We're simply looking at liquidity. The liquidity here in the market with trillions and trillions of dollars changing hands, algos, everything else means that the supply and demand, the actual orders taking place, can move things, even multi-trillion-dollar assets, incredibly quickly. And so I shared earlier in Telegram, if you guys didn't believe me before a couple of weeks ago when I said, listen, this is not really a recessionary market. We're not seeing, something hit and then, it's going to affect automobiles, or it's going to affect energy, or it's going to affect AI chips. It's not really about that. It is about the liquidity, the panic selling, and the opportunistic buying that's going to move this market. And if you didn't believe me before, hopefully you believe me today, because as these sectors show you, look at everything moving in tandem. And you have to ask yourself the question, is the news both tariff on and tariff off really going to affect the market the same across technology, across energy, across consumer staples? Is it really affecting all of those sectors, the change, the actual macro elements? The answer is, of course not. It has major, massive different implications for those different sectors. And yet, if you look at them, they all look the same. Go look at ExxonMobil today versus Walmart today versus Nvidia today versus even gold today versus Bitcoin today. They should not experience these market conditions the same, and yet they do. Why is that? Because it's the actual liquidity. It's the buying and selling pressure that is dominating where this market goes, not some value proposition of how the tariffs or anything else are going to affect individual stocks or sectors. So I think that's so important to understand and make sure that you're aware of. So what does that actually mean for us as traders? Well, what it means for us is that we are not going to get on the right side of this market based on predicting how macro elements affect stocks. Now, I say that overgeneralized. Obviously, in reality, there are some certain stocks and sectors that I think are better positioned. Don't get me wrong. Obviously, that's why I hold gold. That's why I don't just trade the S&P only or the QQQs only, which I trade mostly, but not only, because I do believe there are better value propositions when you really get into the weeds. But generally speaking, what's actually going to turn around the market is not based on that. It's based on when liquidity decides to get back into this market. How do we know it? Well, we know it based on examples like today. How else do we know it? 2020. How else do we know it? 2010. This is not new. This is age old. Liquidity drives the market, not news, not earnings, not speculation, not even the crazy value propositions, because those are all a net result of where liquidity is going. The reason that we had a major bull market in this, April 2020 through 2021 is not because the values made sense. It's not because certain sectors were better positioned. None of that really mattered. It's because trillions, and I mean trillions of dollars, entered the stock market. Now, how they entered the stock market, we could go down a whole path, okay? We could talk about all the different loans. We could talk about the stimulus. We could talk about certain companies getting it. We could talk about government deals. All of that is true, but it doesn't really matter. What matters is that trillions of dollars entered through retail, entered through bailouts, entered through loans, entered through other types of direct stimulus, and they all circulated into the stock market. That's why the stock market made a massive historic run from April 2020 through 2021. Again, not because of one of those companies was better positioned. None of that really mattered relative to the liquidity. And so I'm beating this dead horse because I want you guys to understand that's also what we're going to need to happen here. We're not waiting for valuations to make sense. We are waiting for liquidity. Okay? How are we going to get that liquidity this time around? Well, it's not going to be from the government stimulus, which means it's probably not going to happen nearly as quickly, unfortunately, as it happened in 2020. It's going to have to happen through institutions, through insiders, through the wealthy, and then ultimately through retail traders. Now, the number one thing is that we need to watch for insider buying, right? That's going to be the number one thing to give us a telltale sign that we are entering new liquidity back into the market. Right now, it is not picking up yet. For me, that means we're still risk on. We haven't found a clear bottom yet. We need to be very, very cautious, okay? That's why I'm continuing to do the three things that I keep reminding you guys to do. Pair trades, covered calls, mechanical systems. I'm not taking high discretionary trading. I'm starting to accumulate certain things like mags. I'm starting to accumulate certain things, but I'm not trading actively and directionally nearly as much, except for the mechanical trades, because this is not giving me confidence yet. Okay? The liquidity that we're going to need to push this market back up is not going to happen from the government printing trillions of dollars. It's going to happen from institutions and insiders, and then ultimately through retail buying back into this market, throwing liquidity at assets. We're not seeing that yet, and until we see it, it's not going to have a high degree of confidence. Doesn't mean we're not going to get bounces. I think we'll get some shake-ups, some shakedowns, We even got that in COVID, by the way, even before the real catalyst ticked up. We had some positive 2 and 3% days. But until we get this moving up, I don't think we're going to get a lot of stability. Now, when can that happen? Well, the NASDAQ actually hit the 25% correction level already on this morning's open. If you guys remember, I talked about this 25% correction level going back mid last week, never thinking that we'd get there so darn quickly. But here we are. We actually already hit the 25% correction level on the NASDAQ. Now, I think that means that we could see this, act as some kind of floor, but I think it's unlikely. In my mind, it's unlikely that the NASDAQ is going to be a floor at 25%. I see the NASDAQ potentially being 30, 35, or even a 40% correction if we don't see insider buying start stepping in. I think what we need to watch more closely is actually the SPY, the S&P 25% correction. I think that's a better level to keep in mind here. And we're still a couple percent away from that. So for me, again, until insider buying steps in, I think the 25% correction level on the S&P is a more kind of concrete level to watch. Now, if we hit this level, I'm essentially going to be all in on buying value. Now, when I say value, I don't actually mean value stocks. I basically just mean correction value, where I think that the market is at a big enough flush where I can feel comfortable buying in. Doesn't mean that 25% correction is the floor. We could certainly see a 30, 35, or 40% correction on the SPY as well. I think it's more likely that we'll see that on the NASDAQ, and 25 or 28% is more like the floor on the SPY. But keep in mind, we saw 33% just in COVID in 2020. So it's certainly not to say that we couldn't see a bigger shift than that, because you could also argue, and I think very easily argue, that the fundamental shift we're getting in the market right now is more significant than what we saw in COVID. We're seeing a major fundamental change to how this market's going to operate, and we're not going to get the stimulus bailout that we got in 2020. So to me, the floor is actually lower. I hate to be the bearer of bad news, but I think the floor is actually lower for the SPY than what we saw in COVID. Now, I don't think we're going to get there because I think people are going to start to price in the tariffs and say, okay, yeah, we get it. The market's fundamentally shifting. The floor might be lower. However, we're starting to price in the reality of this. We're starting to price in some surplus that kind of balances against the negativity. So I don't really think that we're going to get there in that 40, 50% range on the SPY. But I just want to be clear that that's what the floor really is here, that it's lower than it was on COVID. And if you guys are wondering, okay, so Nate, it could be 25%, it could be 30%, it could be 40%. What's the deal? Well, I just refer you back to this chart. This is what I'm going to be watching for. The floor is not going to be based on a certain percentage. I'm telling you right now, if it gets to 25%, that's my number. That's what I'm pushing. I'm putting all the chips on the table at 25%, even knowing I could take a deeper hit. But it's really the insider buying that I'm going to feel most confident sets the floor. Okay, so does that make sense? Before I move on, I'm going to cover our trades from Friday and then our next opportunity here that I'm taking live with you today. But before I move on, I just want to make sure that makes sense. We have the NASDAQ here at a 25% correction. Could be a floor. We have the SPY several percent away from a 25%. Could be the floor, but based on where the market fundamentally is, I think the actual, the true bottom potential is significantly lower. And in order to find out where is it on that range, anywhere between now and a 40% correction on the SPY, how am I deciding? Well, it's going to be based on the insider stepping in, because ultimately I need liquidity in order to have confidence that the market is going to go up. Give me a yes in the chat if that makes sense to you, because I'm going to continue. You guys are going to hear me. It's going to get really boring to listen to me over the next week or 2 or 4 or 6 or however long it takes, because I'm just going to keep saying the same things. And I apologize for being boring, but I really think these are the best opportunities. When buying steps in, we get bullish. Until then, we do those 3 things: pair trades, covered calls, mechanical systems. Everyone with me? David, Sam, Jim, Jennifer, Janine, John. Okay, thank you. This is where I'm at. Again, I apologize. I would like to give you a super sexy, hey, here's this penny stock that I think is going to explode on the back of this, but just not the reality, folks. Where I'm at is we need to wait. We need to find a floor based on where liquidity enters the market. And then I personally think it's great news from there. Because even though it won't be a booming bull trend, in my opinion, like we got in 2020, because there won't be trillions in liquidity to push it, I still think we're going to get a grinding opportunity to take advantage of that most people are going to be too beaten up to take advantage of, frankly, that we can step in. So thank you, everyone. I just wanted to make sure that made sense before we jump in. Let's take a look at our weekend trade. So a couple of you asked, what did we do? We did MAG 7 calls. MAGS is the ticker versus SPY puts. These were our big winners. Oh, wait. Yeah. MAG versus SPY. These were our big winners here. Opened up. SPY for me, I think, was up about 160% or so this morning. MAGS, of course, was down maybe 50, 60%, but still really nice net winner here. If any of you took that one. XOM versus COP. This was basically only up 1 or 2%. I still have it open right now, but just slightly positive. I'll take it. Walmart versus TGT. Still have this one open as well, but doing great. You could have closed it first thing this morning for a nice win. You could have closed it during the pop for a nice win, or you could still have it open looking for more like I do. And then IBIT versus BITO. IBIT calls, BITO puts. Really nice winner this morning, as well as Bitcoin open like negative 11%. So these were our 4 trades. If you took them, I have closed MAGS versus SPY. I'll probably open it again, frankly, later this week. I have closed IBIT versus BITO. I'll probably open it again later this week. And then these 2 in the middle, I still have open currently and doing pretty well. All right, so stick with me, folks. We're gonna keep doing this. Correct, Linda. They're traded separately. So you'd buy the MAG calls, then you'd buy the SPY puts. You buy an XOM call, then you'd buy a COP put. 2 separate trades in each instance. So stick with me, folks. We're going to keep doing this, looking for opportunities. We're also going to keep doing the 2-way trades, which I'm going to give you an opportunity at the end of today's briefing. If you want to watch the presentation and get into 2-way options before our next trade, again, can't imagine a better strategy to have right now. We'll play that presentation and give you a chance at that as well. Before we get in, let's jump into our next opportunity, our next trade here, another pair trade, XLC versus XLK. This is communications long versus technology short. So basically what we're trading here, I'm going to overgeneralize, this doesn't cover everything in the basket, but we're trading long Meta, Google, Netflix, Verizon, T-Mobile versus short Apple, Microsoft, Nvidia, Broadcom, Oracle. Now, here's what's interesting. On this pair trade, XLC versus XLK, I'm not super bullish communications and super bearish technology. That's not what a pair trade is. I just want to be very clear here. I'm not super bullish on communications and super bearish on technology. I'm about 52% to 48%. This is basically a coin flip trade here for me. I'm not trading it because I think communications is going to go up and technology is going to go down. I'm trading it because I think communications has the edge, and more than likely, both are going to go up or both are going to go down, just like we saw on SPY and MAG, just like I talked about on Friday. Okay? I just give communications a slight edge here, and that's all I need for a pair trade. Because if this market moves 4%, or heck, tomorrow moves 8% intraday again, I don't care if both go up. I don't care if I lose 100% on one side. I'm in position to make 150, 200, or 300% on the other side, and that's what we want in a pair trade. So I'm just giving XLC the slight edge here. I think it's held up a little bit better. I like its position better. If you look at like T-Mobile, it's held up a lot better than something like Avgo or Apple even for that matter. And so I'm just giving it the slight edge, and that's all I need for a pair trade. If we get a big move in either direction, we're going to be in great shape. So you guys want to take this one together? Yes, in the chat. I'll go to my brokerage. We'll take this one together. If you want to do this trade right now, live, I'll show you the exact options that I'm buying and selling. We can do that right now if you guys want. Okay, yes, yes, yes. All right, we will do that then here in about 10 seconds. All right, before we do that, just a quick reminder, members, if you're a member of any of my services, use my email directly. Thank you to all of you who have sent me emails. Some of you just sent emails saying thanks for opening up this channel, but other of you have sent emails asking tough questions like, why are we losing on overnight options? Totally fair, totally valid. I'm happy to take all of those questions. Hopefully my responses have been adequate so far, but I'll be keeping an eye on that email. That's for any member of any service. If you don't have it, just email our main support and say, hey, I need Nathan's personal email. They will give it to you. If you're a member of any service, you can email me directly. Also, as always, make sure you're in my Telegram. If you're in my Telegram, that's where you're going to get updates like pair trades. Hey guys, I'm closing out the Walmart Target trade. You're going to get that update in Telegram. So make sure you're in Telegram. You'll also get all my other updates. And then lastly, make sure you're on the text message list. That's just the phone number list. You put your text number in there. I'm texting a stock of the day in there directly every day, Monday through Friday. And so if you do that, I will throw it in there. And all you have to have is your number on file, and you'll get that text message each day. The main support is support@prosperitypub.com. I'll type that in there right now, support@prosperitypub.com. And if you want my email, just say, hey, I want Nate's email. If you're a member, they'll send it to you, and you can email me directly. All right. Yeah, we keep the chat private unless it's a members only session, just because some people are sharing their personal email, their phone number to get contacted, stuff like that. We want to protect everyone's privacy. So I can see your chat, but not everyone else can. Okay. Again, just those 3 reminders. I wanted to make sure you have all of that. And then we'll jump in here. So let's go ahead and jump into our trades. All right. So by the way, QQQ, now what are we at here? Up over 1% this market. Okay, no, I don't let the loser expire worthless on pair trades. Let me show you. Okay, so here we are. Okay, can everyone see this box with all of our trades? Okay, so here we are. Today, this is just, by the way, this is just my small trading account. So I only put like 1 or 2 contracts in on Friday. This obviously doesn't represent all of my other trades that I put in my main account, but that's fine. You can still get the idea. These are the ones that I put in live. So Linda, can you see here the P&L channel, or column rather? Let me know if you can see that, Linda, on the right side here. Okay, so on top here, I have the SPY trade. Okay, this was my puts. Then down here, I had the mags. This was my calls. And I tried to even it up with about the same amount of volume on each side. So these two went together. What you can see here is this morning, this trade is now closed. That's why the net liquidity is 0 on these two. So this trade is closed. I closed the SPY for $928 in profit while closing the mags for a $556 loss because they went down. So I lost money on the mags and I made money on the SPY, but I made more on the SPY than I lost on the mags. Exactly what we want to do. And just on a relatively small trade, because I think I only put 1 SPY contract on here, I made about $400. So on 10 contracts, you would have made $4,000 on 1 pair trade. Okay. So that's the example here. Okay. Now Walmart and Target are a little bit different because I'm actually winning on both. Okay. So that's these two. Okay. So that's these two. You see these two? So Walmart's up about 10% and Target's up about 16%. Okay. So we're actually positive on both here. That's Walmart versus Target. Okay, then we have XOM and COP. This one was positive, but now just actually flipped to negative. So I'm down about $60 on these two. I was up about 13 whole dollars, but now I'm down about $60. And then lastly, we have the IBIT, BITO. That one's up here. And you can see, again, lost money on IBIT because it went down. But I made money on the BITO puts because it went down. And the net difference here was about $162. That's just today, by the way. The total trade I think I made around $600 on. But that was just today. P&L $375. So again, you do 10 contracts, you're going to make $1,600 on this 1 pair trade, even though the assets are totally correlated. Okay, so that's what we're trying to do. Hopefully this makes sense for everyone. If you're brand new and you've never done a pair trade, you got to get the hang of it, obviously. But we made money on all these pair trades, except for XOM and COP, now down a little bit, but still open, even though they're totally correlated because we got a big move in the stock market. So if you think you're going to get a big move, pair trades are a great opportunity. Okay, now what we're going to do is we're going to go trade XLC versus XLK. So Linda, to answer your question, I'm not waiting till they expire. I close them as soon as they're up a certain amount that I'm happy with. And that can vary simply based on how much the market has moved and how much time is left in the trade. If I have lots of time left in the trade, I'll be patient and go for a bigger winner. If I don't have a ton of time left in the trade, I'll take it off when it's up to, a satisfactory amount, 25%, 30% net. Keep in mind, if you guys make 30 or 40% net profit on a pair trade, that's really good. Why? Because you're hedged the whole way. So if you're hedged with two correlated assets and you make a 30% trade, that's huge because you basically have very limited risk that you're going to be able to lose money, and yet you're still making a net gain on two correlated assets, 25, 30, 35%. So those are big winners, and I'm very, very happy to take 25 or 30% on a pair trade. All right, let's take a look at XLC versus XLK. Now, the first thing we're going to do, folks, is we're going to see how much each trade costs because we want to manage. Okay, so step one is, of course, choose paired assets. Okay, step two is going to be to look at the cost of the trade. Okay, very simply. What we want to do here, trading, we'll probably trade the 10-day out, by the way. We'll probably trade April 17th. 10 days to 15 days out gives you a nice balance of enough time to let it move, but close enough that you're going to get those nice inflated returns based on market moves, which is what we want. We want to be able to, make 200% on one side so that if we lose 100% on the other side, we're still going to get a nice juicy gain. But in order to match it up, we need to have about the same amount of risk on both sides, right? Because if you have $5,000 in one trade and you have $1,000 in the other side of the trade, and the $5,000 side is the side that ends up losing, you're not going to be in good shape. So we want to have a very close amount of risk on both sides. So remember, XLC is the side that we're buying. So what we're going to do is we're going to look anywhere from like 1 to 3% out of the money. Now, why are we buying out of the money in most cases? Well, because again, we want to give the market a chance to spike our gains. We want the gain side to be the side we're focused on. And to get bigger gains, like triple digit gains, you want to trade out of the money options. So in this case, to go, anywhere 1 to 3% out, what we can do is we can go to about the $90 call on XLC. And if I click the $90 call, let me drag this down a little bit, you can see it's trading for about 240 to 250. Okay, that's based on the mid price. So what we know is that an average contract here for 3% out of the money is going to cost about $2.50. Before we take that trade, we want to go over to XLK. And we want to see, okay, how much are the puts going to cost us so we kind of know how to manage this trade. And if we go down here, again, same idea, 2-3% out of the money, what you're going to see are that the puts are way more expensive. Anyone shocked that the puts are way more expensive? Not I. So about $180 is going to give us, that same reasonable 3%. And it's literally about double the price to buy our put as it is to buy our call. Okay, we can even go down to 179 and get a little over 3%. We're still going to be about double the price. Now, this is important because now we know how we're going to match up our contracts. In order to match up our contracts, we're going to even adjust our strike or exactly what we're doing to get the right amount of volume on each side. Because again, you want to have the actual liquidity or the risk even. If you've got $1,000 in one side, you want $1,000 in the other side because you want to make it so that if either side moves, you're balanced out. If one trade goes up 200%, regardless of which side goes up 200%, you want to be in good position. Okay. Now these puts are crazy. I mean, we're paying some expensive money for puts, but it's okay because we have the calls on XLC, or we will have the calls on XLC. Okay. So what I'm going to do here is I'm going to go pretty far out of the money, probably even a little further than I usually would. I'm going to go ahead and grab the 178 puts because that not only gives us a higher profit potential if the market crashes, but it also helps me more easily match up my XLC calls where I can do 2 XLC calls versus 1 XLK put. So let me go ahead and put the first side of the trade in here, which is going to be buy the April 17 178 XLK put for about $5. All right. That is the first side of the trade. And then what we're going to do as soon as we get filled, we're going to jump over and we're going to trade the XLC side of the trade. We're going to put on both sides again so that if the market moves big in either direction. Now, for me, one of the simple questions is which side do you put on first? I just put the side on first that's more expensive usually because it's easier to match up. And normally whatever's more expensive is kind of the higher risk or fear side of the market. So in this case, because there's lots of fear to the downside, putting the put on makes more sense. It's more of a natural hedge anyway. So let's go ahead and see if we can get filled for $5. I'm just going to do one contract here just to show you if we can get filled here. You can see here our max loss is $500 because that's what we're going to pay for the trade. See if we can get filled. Boom, filled instantly at $5. I might have paid a little too much. Maybe you guys can get filled for $480 or $490. Okay, so as soon as I get filled, what am I doing? I'm flipping over to XLC and I'm putting on the call side of the trade right in this $90 range. And let's see if we can get filled for, all the way down to 225. See if we can get filled. I'll even try for 220 here and see if I can get filled for that since the other one filled so quickly. And so same thing, we're going to buy the April 17th. I'll type it here in the chat. April 17th, this is going to be the $90, but in this case, we're not buying puts, we're buying calls. And we're going to see if we can get in here for anywhere around, let's say 225. Let's see, I'll bump it up to 225. And in this case, I'm going to buy two contracts. Why? Because I want to balance out each trade. Whoa. Somehow I went to 6. How'd that work? Two contracts, 225. $450 of risk, so $450 versus $500, getting those as closely tied together as we can. And let's see if I can get filled. Now notice, I'm going to try to get two contracts of XLC for every one contract. So if you bought 10 XLKs, you'd buy 20 XLCs, right? 2-to-1 ratio to keep that risk in line, because keeping that risk in line is what makes the actual pair work. Okay, this is sitting right around 230. I'm going to give it a minute and see if I can get filled. Let's just take a quick look and see what XLC is actually doing. It might be popping in the last 15 minutes or so. Not a whole lot. We might be able to get filled here if we're patient. Let's give this one 30 seconds, see if we can get filled. Now, you don't want to be too patient on a pair trade, folks. The reason you don't want to be too patient... Oh, filled. Boom. All right, there we go. Filled on both. 225 and $5 is what I'm in. You don't want to be too patient on a pair trade because you don't want to have one side open and let it run away from you unless it's running away to the positive side, but you don't want to let it run away with you. The whole point is to have both trades on during the market fluctuations. So sometimes you do have to up your limit, pay what's required, but you can be a little bit patient and make sure you get into a good spot. By the way, notice XLC up 1.22% today. We compare that to XLK. It's going to be doing better. XLK. Oh, XLK jumped. Okay, about even. About even here on XLK. XLK is jumping. Not bad. But you can see they're very mirrored, right? Which is what we want. We want correlated assets. There's a reason I'm not trading against energy or utilities because they're not correlated, or staples. XLC, XLK, very correlated. I give XLC the slight edge, but if they move huge, very likely both are going to make that move. Okay, does that make sense to everyone? Everyone understand confidently what a pair trade is, how you put it on, and why you put it on. Give me one more yes in the chat, and then I'll leave you alone on giving me the yeses in the chat just to make sure this all makes sense, because to me, this is about the most important thing you can learn. This, and of course, two-way options. So pair trades and two-way options are going to be the two types of trades that I really want you guys to learn and focus on as we trade in these crazy volatile conditions. All right, good. And so again, someone asked, why the put side? The put side is because if the market goes way down, we want a put that's going to outperform. If the market goes way up, we want a call that's going to outperform, okay? That's the whole secret sauce of a pair trade, just like we hit that home run on the SPY puts this morning. Okay, so the last thing that I of course, want to shamelessly recommend to you guys is that you join two-way options before our next trade. Sam, yes, what I'll usually do is I'll make sure that the prices make sense, that I can get filled, and then I'll add contracts based on how aggressive I want to be. You're exactly right. I'll make sure I get filled, and then I'll add as many contracts as I want based on getting filled and knowing that the trade is set up. Correct? You're exactly right. We have our two-way trade. A couple of you mentioned. How many of you here already got filled on the two-way trade, the QQQ, this morning? I think I saw 3 or 4 of you who already mentioned that you already got filled. And we're going to have our next two-way trade either today or tomorrow. Some of you might still be waiting for that two-way trade just because volatility is so insane. Dan got filled, Jim got filled, Henry got filled, Karen got filled. I got filled on some, but still waiting on others. Just the volatility is so crazy that it's, trades aren't filling as quickly as they should, but we're still in phenomenal position on the two-way trade, just like we should be with big market moves. And now, what is my prediction? Well, my prediction here, I'm going to give you guys an amazing prediction. Okay, you can't get this anywhere else. Here's my big prediction. I think from here, the market is either going to go up or down. All right. Now, I don't want you guys to share that big, bold prediction outside of this very close-knit community, because it took me years of analysis to come up with that prediction that from here, I really believe the market's either going to go up or down. And if you're like me and you have a very confident prediction like that the market might go up or down from here, well, then two-way trades is probably how you want to trade that. And I'm being tongue-in-cheek here, but I'm very serious. With this level of volatility, we're in such an open space right now that if the market opens up 3% tomorrow or down 5%, neither one will surprise me in the slightest. So what do? Well, two-way trades, right? You're literally covered in both of those scenarios. So I highly recommend. All you have to do to check out two-way trades is stay right here in the Zoom room. We'll play the entire presentation for you. All you have to do is sit tight, go ahead and watch 45 minutes of me explaining what it is, and then join. And if you join today, you'll get in before our next two-way option trade. So we're going to set that up. Hang tight. Shameless plug, I know, but I can't really recommend anything more highly than something that's perfectly positioned to trade in both directions right now. I know a whole bunch of you guys in here are already in. Thanks for being in. I'm excited about our next opportunity. I think it's a no-brainer. And the beautiful thing about two-way options is, like most of my strategies, we set up a target in advance, right? So that when the market shakes up, we don't have to watch our trades and guess when to get out. We just let the trade do the work, whether up or down, either direction, we're in position. So hang tight, watch this presentation, jump into two-way options before our next trade, and I will see you on the inside. Thanks again for being here. Hope this session was valuable.